So today I'm going to talk about this trade I took on Audjpy. I made about 4% on this first trade. On this second trade I made about 2%. So I'll be sharing the trade on the screen so you can see that I took this trade on my MT5. Now, why did I take this trade? Is basically just using market structure and liquidity. So we all know that whenever we have a break of structure, we wait for the market to push up and we sell to the downside, which is correct, right? And whenever we have a break of structure to the upside, wait for the market to retrace back down and you push to the upside. But when do you take that buy? When is the right time to take that buy? That is what most traders find very difficult to do in the market. So you need to understand liquidity in order for you to know the exact time the market is about to reverse, and you'll be good to go. So the first model is what I used here, my first model, which is what I'm going to discuss in this video. If you want to know more about this liquidity concept, you can watch my old videos. I discuss more on liquidity. So this model I used is what I used to take this trade. As you can see, we had a break of structure, but I want you to pay attention to the way the market broke structure to the downside, and these internal structures here can be called what? Liquidity. Because we know that this is the high, this is the overall high that gave this break of structure, right? So this is a no-go area. So what do you want? We want the market to do what? We want the market to either reverse from here, or the market should do what? Reverse from here. One of these 2 points, because these are the liquidity points in the market. So now we know that where the market is going to sell for, right? How do we get in the trades? It's very easy. You also pay attention to the way the market is pushing back to those reversal points. So let's say this market is pushing up like this, creating higher highs, creating higher lows, created a new higher high, and the market did what? Created a new higher low, created a new higher high, and we had a change of structure. Once we have a change of structure, you can then say, okay, this market hit a breaker block here, swept liquidity, and we had a change of structure. So now you can start selling to the downside. But if the market did not change structure, you stay patient and you wait for the market to continue pushing back to the next reversal point, which is the next liquidity. We take out the next liquidity, and what will happen? We are going to do what? Change structure. Then when we change structure, you wait for retracement to get a good entry and you sell it to the downside. So as you can see, I use liquidity, I use market structure, and I still use market structure to enter. So it's just actually using liquidity and market structure, right? We waited for the market to retrace back up to take out liquidity, and if the market had taken out liquidity from this high and change structure, I would have taken a sell. And if the market take out this last liquidity and change structure, we are going to take a sell too. So this is basically what you have to do in the market. You spot out the overall break of structure, you spot out the liquidity point, and you wait for the counter trend to also switch bearish or bullish following the major trend. So for example, the major trend is bearish. You want the counter trend, which is pushing to the upside, to take out liquidity and also shift bearish to the downside. So now the counter trend is bearish, the major trend is bearish, and again we have taken out liquidity. So what do you expect? The market is going to do what? Push to the downside. Now I want to show you the trade I took here, and I'm going to use FX replay to explain it to you so you can see. So as you can see here, we had a change of structure, and we had this first liquidity point, and also we had this liquidity point. Now why did I call these two liquidity points? Is because this is the high, this is the overall high here that did what? That changed structure. So anything between this high is considered what? Liquidity. So we had this first liquidity, and we had this what? Second liquidity here. This high here as liquidity. So what did I say? If the market take out this first one and change structure, what are we going to do? We are going to sell. The market take out this last one and change structure, what are we going to do? We are going to sell. Now the major trend is bearish. Now look at the counter trend. As you can see, the counter trend is also what? Bearish. The counter trend was pushing on on a high here, a low here, a high, a higher low, a higher high, and what happened? A lower low. So as you can see, the counter trend and the major trend is also what? It's also bearish. So now we have taken out liquidity, we have tapped into a breaker block, a POI, and also there's an imbalance here. And again, we took out liquidity, we have changed structure. So what do? I took my sell right here around this place, my first entry. So let's talk about the first entry, forget about the second entry. That's just a re-entry to maximize my profit. So my stop loss also were right above this high. I guess I suppose it was right above this high, and I went for a 1 to 4 setup. This is how it's not actually easy. It comes with practice. You need to practice, you need to shine your eyes properly in order to see this setup appear every time in the market. So as you can see, we did what? Smash TP. If I push the market down, you see that we smash TP to the downside. And this is how you use market structure, liquidity, exactly what I taught here. Market structure, liquidity, and you wait for the market to take out either the first liquidity or the second liquidity, change structure, then you can start selling to the downside. If you do this in the market, 90% of the time you're going to be hitting TP.